Hi, this is Charles Kelly, Money Tips. Welcome back. Today I have a special guest with me, Matteo Turi, who is welcome, Matteo. I'll just briefly introduce you. He's a finance leader, investor, board advisor, and spent nearly 2 decades working with businesses at pivotal moments in their growth. He's a former CFO, biotech, SaaS, and renewable energy. He now brings perspective as in terms of mergers and acquisitions, M&A investor, currently overseeing $480 million in acquisitions. And he's also sat on both sides of the table, scaling ventures and as an operator and evaluating deals as a buyer. So a lot of experience. He also helps founders understand what makes a business truly attractive to investors. In 2017, he created the Global Growth Blueprint to address a gap in entrepreneurial education, wealth creation. And while much financial training focuses on managing capital, Matteo emphasizes on building it through monetization, intellectual property, succession and leadership, planning, global expansion. And this approach has since evolved into the High Valuation Triangle, which we want to hear more about, a model that applies to the 5 stages of business, which is, I'll let Matteo explain what they are. He shares his insights through the Exponential Blueprint newsletter, followed by over 22,000 founders, which is great. I think that's really well done. Investors and executives. In September 25, he will launch his premium counterpart, the High Valuation Code, alongside the forthcoming book, Fail, Pivot, Scale, Your High Valuation Code Revealed, drawing on 21 case studies from household names such as Amazon, Netflix, Tesla, and Airbnb. The book shows how most iconic companies turn failure into fuel pivots into turning points and scaling into an unstoppable momentum. So that'd be really interesting to read about those large companies. And I think that's about it. I mean, it basically equips entrepreneurs with a practical playbook for breaking through growth barriers. So a lot of experience. So welcome, Matteo, and it's great to see you. You're based in London, I believe. So welcome. And out of all of that experience, what has been the most interesting for you working on? Is it your current role in mergers and acquisitions? What you've got such a wide range of experience there.
Thank you very much, Charles. Yeah, in fact, effectively, my experience has been all about operation, being inside the business as opposed to managing a business from the outset. I would say there were so many situations I've been involved in, but you tend to learn so much more sometimes about repairing a failed situation. For example, I work for a big FTSE 100 company that had a crisis management to be resolved. And I remember back then, I used to be a chairman of a steering committee meeting every week with the board. And I remember how intensive it was. But those are the situations where, as I always say, the biggest lesson are in our business lives that when you fail, you want to really fail really fast. And when you pivot, you have to pivot decisively, and then eventually you scale strategically. So these 3 actions are effectively what histories tell us really, really works. Yeah. So the purpose of what I do, what I created in 2017, which is a framework for entrepreneurs to level up with investor. So what I wanted to create really is a framework which level up effectively business with investor, put them in at the same level. And yeah, the reason is because our education systems are not really designed for wealth creation.
No.
There's a lot of education about wealth management, unfortunately. Yeah. And if you want, I can also give you some examples, some practical examples of some real household names that really did exactly that. Yeah.
Yeah, I'd love to hear about that because I'm always fascinated how some businesses grow to become huge companies and others kind of stay small or they get to a certain stage and then they can't get to the next level. But some businesses just seem to do so well. And so that's really. But you've created this global growth blueprint. And as you said, we're not taught about this in education. And if anything, people are taught. I mean, some of the banks and insurance companies are trying to get in on this and just telling people, "Well, put your money into an ISA, do that," and the usual stuff, which is okay for most people, but it doesn't really help the entrepreneurs who want to grow businesses, does it? So it's good that you've got this blueprint here.
Yeah, effectively, what we're trying to address is the reason why businesses fail. Businesses fail when we look back at the biggest failure. Most of the time is either lack of financial intelligence, or we can even call it unused financial intelligence. So financial intelligence is there, but it's not necessarily leveraged in such a way that a business can actually be successful.
Right.
And actually even more painful because what you tend to see is that, there is an opportunity there for the business to do the right thing, but it doesn't because they don't address really the right framework. What I really have put together is a framework that addresses this fact.
Right.
Wealth is not created at random. Wealth creation follows a code, which is what I call eventually the high valuation code. And the high valuation triangle summarize the three big reasons why a business should attract an investor effectively. Not only that, but obviously we know each business is unique. Uh, However, within that uniqueness, we need to identify which one of the five stages a business is found. Yeah, you want me to tell you more about those five stages as well?
Yeah, please do.
So basically, yeah, each business at the moment, at any given time in their history, they're in one of those five stages. Yeah. Number one, startup. That's effectively when you're a pre-revenue business, when you are going from concept to validation, and from validation eventually to development and then to the market. Yeah. The second stage is scale up. Scale up is a transition from startup. You now have a product, you have a market, so you have to scale up your business. The first stage is stagnation. Now, stagnation is when effectively you plateau,
Yeah.
you hit a plateau, and then you have to eventually, yeah, you have to create new ideas for new market. You need to perhaps go back to what you did in the startup phase. The other fourth stages could be crisis. Now, crisis usually it is preceded by stagnation. So sometimes, if you do not do the right thing, a stagnation, you can end up, unfortunately, ending up in a crisis. The other stage is exit. The fifth stage is exit. So each business at the moment, each situation as we speak, to anyone who is listening to us, falls into one of those five stages. Now, for each stage, you have to change behavior effectively. You can't behave in the same way. You cannot create wealth in the startup phase and in the crisis phase in the same ways. So, because each situation is unique. So, effectively, that's what I'm addressing with the high valuation code, and which is my premium newsletter, and which is inspired by the book called Fail, Pivot, Scale. So why those three words? Because that's really what happens when that's what history tells us happens when you're successful.
Mm.
You fail, then you pivot. You have to pivot. You have to pivot decisively, and then you scale eventually. And I can give you some example of some household name that we know very well.
Yeah, please do. Yeah, I'd like to hear that. Yeah.
Okay, let's imagine, let's go back to a name that everyone knows very well, like a startup phase. For those who remember Amazon, yeah, like before the year 2000, yeah.
Yeah.
Now, how do you create wealth in the startup phase? Yeah, in the startup phase, you create wealth by proving the value, by creating and protecting your intellectual property. Now, intellectual property, again, is part of the high valuation triangle, is the first step. And it's where for example, in the UK, there's a situation of less of a knowledge compared to the USA, for example. In the USA, intellectual property it conquers a lot more market than it does, I would say, everywhere else in the world, apart from Australia, maybe. But yeah, this is where in the startup phase you protect your intellectual property. Now let's look at Amazon. They did not try to sell everything from day one.
No,
Okay.
true.
What they did instead, they focus on books. Yeah, what they did is they just focus on books, you know. Now they build customer trust, they nailed the logistic, yeah.
Yes.
And only then they expanded. And they were not actually even that profitable in the startup phase, you know, but they created a strong, I call it the dual reason why you become successful, positioning and structure.
I think
Okay.
for the first few years, he didn't make any profit and he had to keep going back to his investors to say, look, stick with me, guys. We're going to build some. He had a big vision and he had to raise a lot of money to keep going and build the network and the distribution network. So it was remarkable. He didn't make money for a long time. Anyway, I'll let you continue. Yeah.
Oh, that's right. And that's exactly, you know, the key question that any startup need to answer is, do I have a concept? Is that concept validated? Can the validation now allow me to go to an investor to then develop what I validated? Yeah. And then you build from there. Unfortunately, what happens with too many founders, they tend to jump the steps. They go from concept to investor. That's too early. An investor will not listen to you. And you don't go from concept to development. First, you have to validate it. Yeah. So that's an example of the first stage, which is startup.
Right.
And if you want, I can tell you about scale up as well. I got an example about scale up as well. Let's concentrate again, a very well-known name like Tesla. That's one that comes to my mind, Tesla, really. Now, when you scale up, you need to multiply in an intelligent manner. So Tesla is the perfect example. Initially, they have to prove the Model S. And again, you remember Tesla at the beginning, you know, they have to withdraw the first model and then they have to, actually, they pre-booked, they pre-sold it at such a high price, you know. Now, once they proved the Model S could work, they did not chase every idea at once.
Right.
They scaled with the Roadster, sorry, then the Model 3, then Model Y, if I remember well. So what they were doing, they were carefully layering products and tapping also into government subsidies. So very intelligent. You know, they were looking for, because you know, obviously governments were very happy about electrical vehicle.
Yes.
And then at the same time, they were securing the IP protection as well. One of the things I always say, protect and profit. You need both of them. You can't do one without the other one. So you need to protect your intellectual property and then you need to profit from it. So this is what I call wealth creation in action, not just growth, you know, because growth does not necessarily means wealth creation. Yeah.
Yeah. I mean, Tesla, as you said,
And
had their problems early on, didn't they? They had a lot of problems, but and Elon Musk is not he's not a stranger to failure. He's seen rockets going up, millions of pounds going up in smoke, but he's very determined to push ahead. But Tesla's a good example. And as you said, they didn't try and. But I think I read something that they were one of the only new car companies that have succeeded for many, many years. All of the other new car companies have gone by the wayside.
yeah, we've seen so many of them, you know. I mean, you know, I built a big list of car company that trying to
Lorian
do,
comes to mind.
yeah. And the other thing in Tesla, it's about also creating additional revenue streams, you know. So when you have an intellectual, when you really master the first angle of the high valuation triangle, which is intellectual property monetization, then you're much stronger. You build your moat effectively. So you diversify into renewable energy, into battery storage, and you're a much stronger business than the competition. So you build your own defense, should we say, against the competition.
Well,
And
is this
I
why they
did.
were, sorry, is this why they were valued at more than GM and Toyota put together when they were hardly making any cars, and yet they had this super high valuation, and fund managers like ARK were heavily investing into Tesla. I think if you'd put 10,000 in Tesla 10 years ago, it would be worth, I can't remember the figure, but it's somewhere like 1 million. Their shares have done phenomenally well, but what is maybe the reason why their valuation is so high because they've got this intellectual property and software. Would you agree with that? Oh,
Absolutely. And this is where, again, my high valuation triangle back in 2017 is trying to establish as a framework when you own intellectual property, and these are sourced from the European Union, actually, by the way, you have 1,000% more chances to get funding. Now, one of the very sad story we need to tell ourselves is that in the last 20 years, how many non-US companies
yeah,
have really mastered intellectual property monetization?
I agree.
Can we remember many of them? Sadly, not too many. The USA has dominated this space.
Correct.
So what we need to do is to really learn from this, which is why, my framework is about really taking the right example, also the wrong example, yeah, also the wrong example. I can give you a wrong example. For example, yeah, with the Kodak, which wasn't a stagnation. And in a stagnation, I don't know how many people remember Kodak.
Yeah,
Kodak was the number one player in effectively photography,
film.
digital camera, and so on.
Yeah, yeah,
Now, the problem with stagnation, the trap is comfort, yeah. So Kodak invented the digital camera. No one else did it. Kodak invented it, yeah. They, however, made a mistake, yeah. Um, they refused to pivot because film was still profitable,
correct.
okay?
Yeah,
As
yeah,
opposed to Apple. Apple, they did the iPod, but then they have to kill iPod because they went to the iPhone effectively. So iPod was very profitable, but it had a limited lifespan compared to the iPhone, yeah?
true, true.
Now, they mistook revenue for valuation. That's a big mistake. Revenue is one side, valuation is the other side. So what was the result? Yeah. That intellectual property was effectively left on the shelf. Yeah. And competitors took the market. So this is an unfortunately big lesson. Stagnation kills wealth when leadership really lacks the courage to reinvent. Okay, so this is very important. As opposed to Steve Jobs, who, after the first success of the iPod, eventually decided to kill the iPod, yeah, because that's what he did. He killed the successful product to move to the iPhone. Again, stagnation, you don't build wealth in the same way as you did in the startup phase. Yeah. So and then I can give you an example of a crisis. Yeah. If we go back to COVID, many people remember Airbnb.
Yes.
So, so crisis is really where the wealth can be reborn or lost forever. Okay, so that's where you really have to be fast, absolutely, really, really fast at taking action when you're in crisis. Obviously, crisis can kill you.
Yeah.
We always learn in finance that you can die slowly, like cancer, like revenue, or you can die immediately with cash flow crisis. That's like heart attack, effectively. So let's take Airbnb during COVID. Yeah, travel collapse. We all remember that. It's not too many years ago.
True.
So they could have died, Airbnb. Instead, they pivoted decisively to local stays, longer rentals, digital experiences. Yeah. Now, that decisive pivot did not just save them, he actually prepared them for one of the most successful IPOs of the decade. So Airbnb has been an incredible success, but it was about to die in 2020. So again,
But
when you create,
could I also, sorry, they also didn't have thousands of empty properties sitting there with loans on them, did they? They didn't have that liability of all these empty properties. That was the landlord who maybe they were feeling it more than Airbnb.
Yeah, I have to say, the business model helped as well,
Yeah,
asset light. And I've seen personally in London other businesses dying, unfortunately, because of COVID. They, regardless of the government incentive, they unfortunately they could not just recover, and
no,
it just took too long for the property market to be back to where it should have been, because it was a rental market. It was for, very flexible situation. They disappeared overnight, unfortunately. Yeah. Yeah.
yeah. I guess that was once in a generation kind of pandemic kind of crisis, but lots of businesses fail in the startup stage, don't they? I mean, 90% of businesses fail in the first couple of years. So there's all sorts of reasons. But in the example of Kodak, that was a huge mistake, just like another Blockbuster. And I believe that Blockbuster were approached by Netflix to work with them, and they said, no, you're just a small company. And I believe that Steve Jobs approached Kodak, but I don't know how true that is. But and they brushed him aside. But yeah, they were huge mistakes, weren't they? I mean, just devastating mistakes they made.
Yeah, I mean, that's a lesson for many. I mean, another lesson is Blockbuster. They've ignored Netflix. They felt comfortable about what they had.
Too
They
arrogant. Yeah,
become very relaxed, arrogant. That's where again, also my profession, financial leadership, in my view, can do better, because we can definitely try and address issues of lack of financial intelligence. Or, as I was saying before, when financial intelligence is unutilized, it's even worse, because you just miss an opportunity to use it and to make a big difference into the business. Yeah. And I want to make an example also about exit, but not the exit that many people think about. It's because you can have an exit from the business, but you can also have an exit, let's call it from a product. Yeah. So you create a product, but you multiply the wealth you create from that product. Now, an example that we've seen across now more than one generation is Disney. Uh, Let me just elaborate on that, because many people think, oh, wow, Disney is not exited, but it's an example of the mindset about how to create wealth on exit. Now, wealth is maximized by owning the right asset. So you have to own an asset. You don't just uh, create a business without building it. Yeah. So, for example, Disney has mastered this so many times, like Pixar, yeah, Marvel, Lucasfilm. Every acquisition they made expanded their intellectual property universe. When they launched Disney Plus, effectively, many people remember this. They were not just streaming films, they were monetizing decades of intellectual property.
yeah,
So they were multiplying value across merchandise, theme parks, global markets. So that's how you exit with strength. So effectively, you build your intellectual property, in this case with Disney, many decades, and from the same asset, the same, for example, Pixar, this Marvel, Lucasfilm, you create so many revenue streams that effectively exit out of those assets, because eventually there's not much more you can get out of those, but you maximize it with so many revenue streams. That's where
yeah.
you build your business to an exit. And again, this is the technical way of exiting with the highest possible value.
So they're not. Disney is a great example because I was in a Disney park in January, and the amount of money going through the shops, just in that one shop, the amount of money, these toys being sold for hundreds of dollars, and people are fighting over them like it's the end of the world. And I think Pixar was it started by Steve Jobs, another Steve Jobs success, but they picked up on these things. It's an amazing business, from the theme parks to the movies. I mean, every time I go to the cinema, I can't even watch a good film because it's all Marvel comic books, which they didn't even invent, did they? These characters have been invented by somebody else, and they've monetized them in a big way. So yeah, it's fascinating. And also with going back to Bezos, I saw in a documentary about him that he tells his staff to come up with new ideas, and he's not frightened to fail. In fact, he often launches things without too much thought. He said he launched Amazon Prime, and they was, oh, this is a bad idea. And he said, well, let's give it a try. I like that attitude. He's not afraid to fail, which sometimes, and I wonder if these businesses would ever have got off the ground in the UK. I don't think the UK would have funded Google and Facebook and even Amazon for all those years. I don't think they would have got the capital to do these things. And perhaps that's why there's not a single large tech company in Europe that rivals any of the tech companies in America. So it's a good example that America's dominated this scene.
I mean, failure is part of business. Is part of uh, eventually executing your business. The way to treat failure is we need to transform failures into a powerful lesson. Because that's why risk management exists. Yeah. So the risk has to be pre-calculated, then it needs to be managed, and then if failure happens, as it will happen in any of those situations, because there will be lots of failures, the loss will be small. So it will be manageable and you can restart again. And that's why me as a professional for the last 30 years, I've been running risk registers. We always have to calculate the probability of a risk happening, because around the corner there's always a risk. And
Yes.
one of the things we have to obviously teach a school more, to be honest with you, is that when you start a business, you are taking a risk, and the business will have to learn to live with risk forever, because otherwise it's not a business. So the right way to behave is not to try and avoid the risk. You have to manage the risk effectively, and by managing the risk, you end up with with success, because when you lose more. Yeah.
Yeah. So what do you, when you're called into a business, like you said, I mentioned a FTSE 100 company, um, how do you teach them to pivot when things are obviously going wrong? It's a big job, isn't it, to say, well, you've got to move from this business to that business, or, how do you identify where they should go? It sounds like a huge job for a big company, almost like a big oil tanker moving this way, and you've got to try and turn it around. It takes a long time before that thing can turn around, maybe 100 miles, and then it can turn around. You know what I mean? So
I
how
mean,
do
this is where yeah, we can draw lesson from the biggest failure, which they unfortunately stem from the very top, which is the board of
Yes.
directors. Personally, I've been educated with the Financial Times Board Director Program 10 years ago, and I've been a board director in so many situations. I've also been a chairman of a board of directors. Now, the key reason for failure has always been, in terms of board performance, has been board effectiveness.
Yeah.
So we can almost forget about the duties, the liabilities of the board directors. We can forget about the technical aspect of it. When the board doesn't have the courage to pivot, in case of businesses where they don't have a board, when the management or the leadership does not have the courage to pivot decisively, that's an important word. Unfortunately, you are calling for a potential failure, a potential ultimate failure. Yeah. As it unfortunately happened with, say, the big financial crisis in 2008. For example, Royal Bank of Scotland is an example where there was what we call groupthink. Now, groupthink is a killer for businesses, because if you go into the boardroom with the only intention of agreeing with everyone else,
Yeah.
you are creating failure effectively. So it's about really the quality of the leadership, and the quality of the leadership is not something you create in. You cannot really engineer in just a few hours. Really, you need the right people. So that's where I always say, well, productivity runs the world. Our world has a GDP, call it about $110 trillion of GDP around the world. Without the right people, it would be a lot less. If we had better people, it would be even more. So it's always about the right leadership, in my view.
Yeah, you got to always have smart. I think Steve Jobs said this as well. You need smart people around you, and you always look to get the smartest people. And then he said that when you get smart people together, that propels them even further. And it was interesting. He was fired, wasn't he, from Apple, and he came back with spectacular successes later on when they brought him back. But yeah, you're right about group thing. I've sat on boards and I've sat on council committees when I was a councillor, and they don't like it when you disagree with something because they've thought about a way forward, and you say, "But hold on a second, what about?" They don't like it, and they're going to put you down, and you're frightened to speak up because you're going to be ridiculed because they want you to be in agreement. This is what we've decided. We're going forward with this, and if you're the naysayer, I've been shouted at in meetings. Why are you saying that? It's so you
No,
need
but
people with a bit of courage to speak up.
this is effectively why I created this framework called the High Valuation Triangle, because there are three main angles of the triangle that needs to work together. Okay, so the first one is you need to create, protect, and profit from your intellectual property. So
And this will be at the
that's
top
the
of the triangle. This will be the top.
yeah. So the top of the triangle would be intellectual property monetization. This is where we have to admit we are inferior to the USA because we haven't done very well over the last 20 years in creating businesses that can really be rival to Tesla, to
No,
Amazon. There's none of them in Europe,
no, no,
unfortunately.
nothing.
Now, the second angle of the high valuation triangle, it can be called succession planning or leadership. So usually the first part of the triangle, intellectual property monetization, is absolutely necessary in the startup phase. When you move to the scale-up phase, succession planning is crucial because creating intellectual property without the right leadership, unfortunately, will kill what you did before. It will kill your startup phase, which is why the founder, they need to change personality from startup to scale up. They need to learn to become CEO effectively. Because I always tend to use the analogy with football. So you become a football coach, and you have to effectively recruit three key player. They're going to do three things for the business. Number one, sell, like the forward, the attacking goal scorer. Number two, produce, which is the midfielder, the operation director. Number three, generate cash flow, which is usually what the CFO should be able to give you. So you need to create another triangle of leadership, which is effectively three leaders, and the founder should step out of the action and become a CEO. The last part of the high valuation triangle is to go global. So, an investor will put more money into a business if it's got presence in more than one country. That's how we got big lesson from the USA. I'll give you an example. Coca-Cola. Obviously, it's an example that lasted many, many decades. Yeah.
Yeah.
Now, how did Coca-Cola go from the USA to for example, Brazil or to whichever country they went to?
Or Europe. Yeah.
They did not recreate the same business in USA. They shook hands with a bottling distributor.
Yeah.
They retained the intellectual property of the recipe. So effectively, what they did is they went back to intellectual property monetization. They leveraged their intellectual property to end up in a strong position with the joint venture with the distribution partner in this case.
Yeah. They sell the
We
syrup, right?
Yeah, they sell the syrup effectively, but the same can be said about Nike. Nike, again, another American business. Yeah,
Yeah.
they leverage themselves through a distribution agreement, but they always go back to the intellectual property monetization. And I'll give you an example. Sometimes people tell me, "Oh, I do not have any intellectual property," which is 100% wrong. I'll give you an example. I was given a task to do a valuation for a consulting company in the UK. They were making about 50,000 pounds EBITDA, and they wanted to sort of create actually 40,000 pounds, I remember well. So they wanted to raise money for their own consulting business, and they said, well, how can I show a better valuation than 100,000 pounds? I'm not going to raise any money. Then we studied step by step what they did for the client, and we effectively documented intellectual property,
Right.
and we came up with a valuation from 100,000 pounds to 400,000 pounds.
Wow.
Because out of the consulting activity, we created toolkits, for example, we created, revenue out of, speaking, public paid speaking activity, for example. So that became a brand effectively. And the name of the
Right.
company was actually very suited to a branding exercise. So we came up with a valuation of 400,000 pounds after doing a bit of work, so, which is what I normally do with businesses. Yeah.
Right. Right. That's interesting. That's interesting. Just from 100 to 400, but it's not just created out of thin air. You've actually put the work in and created some unique, I guess UBS's unique business propositions, to USPs. I mean, so you've created something there that they were not aware of. And with your triangle, you've got your, I think Andy Harrington calls it a unique business solution. You've got something there that just like it reminds me of the Seven Secrets of Highly Effective People, the Stephen Covey. He had a book, then he created this diagram that goes around the seven secrets, is his UBS, if you like. And he's made that the company's made so much more money from courses and people taking these courses, a bit like the Dale Carnegie concept. But the book was just the start of it, wasn't it? So I'm pleased you've got something there, and I think that's really good.
It's a bit, going back to Disney, it's making money from the same type of theme so many times, creating additional revenue streams, that's where the lesson comes from intellectual property monetization. It's really the top part of the high valuation triangle. That's where everything starts because, yeah, let's face it, the statistics do not lie. 1,000% more funding chances, 300% more exit valuation. I mean, this is what it is, where we can find it in so many examples in the USA. That's why we need to do better, and that's why the high valuation triangle is there.
Yeah, I think with the USA, they've got a big market within the USA, but they also seem to think globally as well. They think bigger, and they've got a bigger vision for their business. So I think that's maybe where they differ. I don't know, but there seems to be more people with money to risk. I mean, my son works for a company that was started by a fellow student of his, and he raised 20 million of capital in San Francisco. And I saw him at the office and I said, he looks like a kid, just sitting in the corner with a sweatshirt on in this office with basketball hoops. And, I said, he looks like a kid, but that company's gone on to be taken over by Blackstone, and they're planning a float. It's to do with the gaming industry. But I really, and this kid studied in the University College London, and he went to America to get his business off the ground. I don't think he would have done it in London. I think he could have got initial funding in London, but not 20 million like that. So that seems to be the place where the capital is. Do you think that's another reason why businesses become much larger in the States?
But history tells us that it's so much easier to go global if you set up your business with intellectual property monetization
Yeah,
in mind. It comes from two big things. Yeah. One is positioning, early positioning. Number two is structure, not revenue, not chasing revenue at all costs. Because let's face it, most founder they chase revenue, not valuation. So they should be taught on how to chase valuation. They tend to hustle for revenue, yeah? Normally,
good.
the way in which I set up the program 8 years ago is the revenue may be slightly, well, may be lower the initially, but you create that exponential growth through the intellectual property monetization method, which is royalties, which is it could be licensing, it could be distribution, it could be franchising, which is the most sophisticated, yeah. So Gillette is an example. Gillette, they sell blades in the same way as Microsoft sells licenses, yeah. So the razor they sell is not really what they want to sell. They want to sell blades. It's okay. And Microsoft is the same. They want to sell you licenses, so they make money forever from you. So
Yeah.
it's when you set up the business that you need to do it well. But that doesn't mean that if you set up your business differently, you cannot pivot so that you can actually create additional revenue streams, or you can actually make the most of it, not necessarily pivoting so strongly, but yeah, to say understand how you can generate more money than what you're doing. And by diversifying your revenue streams, you are obviously generating a high valuation for your business and obviously more investor interest.
Yeah, and I think you can go back to your football example of how the large clubs have created new revenue streams from from selling shirts to deals and TV rights. They've created all these new revenue streams from just kicking the ball around the field. They've done very well. But tell me
It's a
what.
good example,
Yeah,
yeah, because
yeah,
what you're saying is obviously a football club is a brand.
yeah,
It's a lot more than just the 90 minutes there, yeah. It's
yeah.
about aspiration. It's about a sense of belonging. Yeah, it's about really the experience on at the stadium, on the TV, and etc. So yeah, it's a very good example, yeah. And football is where we can actually earlier on I was talking about okay the succession planning should be executed with three goals in mind: sell, produce, and generate cash flow. Now those three leaders should be effectively the recipe for succession planning. So a sales director, operation director, finance director, the founder becomes the CEO. And just to make it more of a fun story, um, the fans at the stadium are like the customers. They buy ticket, which is like the sales of the business. And every time you score a goal, it's like you created a new product, and the customer at the stadium will cheer because you got a new product. Yeah. So yeah, just to give you that fun example about football.
And they sell membership. I mean, for my sins, I'm a Tottenham supporter, and they haven't done very well, but their stadium is unbelievable. They turned it into a concert venue, and they're all sending me emails, buy this and buy that, and I had one today about hospitality deals and that sort of thing. So they're quite good at marketing. But I'm always amazed with football clubs when a team is doing badly and they get rid of the manager who is, like the CEO maybe, and they bring in a new guy and he's got the same players and yet immediately they turn the thing around. And I think you can have examples in business like that, but it just amazes me. We've got the same team and yet somehow he's just made a few changes or inspired some confidence and turned it around.
Yeah, with just one reason, you can create so many revenue streams, and obviously in the case of football team, especially in England, they own the stadium, so they got the ability to generate more revenue streams, and obviously when people go and watch a concert, they will pay a premium maybe because oh well, I went to watch a concert at Tottenham Football Club Stadium, so that's part of the magic of the brand, really.
It's why football clubs sell for a lot more than they used to. Like, the Saudis or whoever buys these football clubs and pays, it seems like they're paying ridiculous amounts of money because it is a brand, like the Americans have done with their sporting clubs and basketball teams and American football. But it's all very interesting now. Sport it's become Premier League has become much more of a business than it used to be. It used to be a sport and people from the local area would go down to the club and pay at the turnstiles, but it's much more professionalized now and it's completely changed, hasn't it? But tell me more about your newsletter. Um, you've got a newsletter now, and what would that cover if people subscribe to your newsletter? What would they get from that?
But I actually started a newsletter in January 2025. It's called the Exponential Blueprint.
Right.
Effectively, is driven. and inspired by the program in 2017, which is the one designed for the University of Plymouth. And in fact, it's all about the high valuation triangle. So it's been going well because it's trusted by 22,000 people, mostly founders, investors, and C-suite executive.
Right.
Um, Inspired, however, by the upcoming book, which I'm going to publish, which is called Fail, Pivot, Scale. I'm starting a new premium membership newsletter called with the same name as the book Fail, Pivot, Scale, the high valuation called revealed. And with this premium service, there will be monthly webinars with the members. And there will also be in-person meetings every 6 months or every year, I mean, depending on the location where the members are, effectively. And every week, the member will receive a high valuation scorecard, effectively. So what they will do, they'll be able to establish that position against the high valuation triangle, and that will be also different according to this stage. There could be one of those five stages. So they will have to qualify themselves: startup, scale up, stagnation, crisis, or exit. So it will be quite interactive, and this is designed, to make it an experience which is very, very, very economic. Effectively, it's less than the price of a breakfast, really, every month.
And so great. So that sounds really interesting. So you're looking for founders, business chief executives, people running businesses, I guess.
I would say the newsletter will be targeting founders who want to know more and increase the valuation of the businesses, really. They want to ensure that they got a guide to give them the valuation. Now, for investor, it would be very interesting to manage the portfolio against high valuation triangle. So how well is the business they have invested in doing against the high valuation triangle? That could be, yeah, a fantastic opportunity also for investor, and let alone for CFO, Chief Financial Officer, like me, who want to be better at their job and understanding better how they can effectively help the wealth creation process. Yeah. But yeah, founders are really prime for this service. Yeah.
Is that any founder? Could it be a small business just starting up from his, spare bedroom, or are you looking for larger businesses? What would you? Could it be anything?
And now any of those five stages is follows a different path, effectively.
Yeah.
So for each one of those five stages, there is the scorecard will help you interactively every week to understand where you are. Now, obviously, yeah, the high valuation triangle is always about those three main pillars. But for example, each week there will be 20 points that can be assigned, and then those points, will help you towards the next week. It's almost like a program that you continue following all the time to understand your position. So
Okay.
it's primarily targeted at founders who feeling burnt out really from what they're doing. They're probably hustling revenue instead of chasing valuation. They would like to be better positioned. They would like to have a better structure to chase more investor as well.
Okay, so it's an ongoing, it's not just something you read, and so that's interesting. It's something you're participating in and improving yourself and your business, and looking for the end goal, as Stephen Covey said, start with the end in mind, so that's part of it. So I think that sounds really interesting. So please send me a link to that, and we'll get a link up there to either your current newsletter or the new one, so that you can continue to grow your audience. I think you've got a lot to offer businesses. Is there anything else you'd like to say before I think we've been going for nearly an hour. Maybe anything you'd like to say before we wrap up, or?
Well, I say thank you very much for having me, Charles. As I said, what we're trying to do, we're trying to help. It's a collective effort because it's a big problem to really shift from wealth management to wealth creation.
Right.
And I will welcome to speak to you again on this subject again. And all I can say for today is thank you so much for having me.
Well, thank you. You've been a really interesting guest, and you've given us a lot of insight into these large companies that we all know and how they grew and how they pivoted. But very interesting what you say, and I'm sure your newsletter will be of interest because, as I say, a lot of businesses do fail in the early years, sometimes through cash flow, sometimes often through lack of sales, marketing maybe. But I don't know. But there's various reasons. So hopefully your scorecard and your newsletters will help these businesses because it's tough running a bit. I've run small businesses and it's the hardest thing in the world. It, it you know employees think it's easy, but they go home and relax, and the founders left there still at night. I used to meet the cleaner every night coming into the building. I got to be friendly with this cleaner because I was always there at 8 o'clock, and sometimes it was hell, but I got the rewards in the end. But what we found was difficult to get to. We got to a level and plateaued, and we didn't get to that next level, and that was our issue at the time. So we did well, but more as a lifestyle business rather than exiting at a valuation later on down the line. So perhaps I should have had your advice all those years ago. I'm not doing that at the moment.
I would say I will sum it up with just 6 words, really. Fail fast,
Yeah,
pivot decisively, and
yeah.
scale strategically. Those 6 words, they should be really bread and butter for everyone who's running a business. Yeah.
Okay, so fail fast, pivot
Decisively,
decisively, and
scale strategically.
scale strategically. Okay, well, on that note, I'll end it there. So thanks very much, Matteo. Really interesting. I hope we can meet again and maybe bump into each other at networking meetings in town. But for now, thank you very much for your insight there. Really
Thanks
interesting.
to you. Thank you, Charles. Thanks.